What's going on, guys? Welcome back to the channel. Welcome back to another video. So happy to be here again. I've been getting a lot of messages from you guys, anything from how to start my first side hustle, how to come up with a great online business idea, or even how to come up with great home-based business ideas. But I want to help one person today. If I can only help one person today, that will make my week. So I got a question today. Actually came in yesterday, and the question was, I have $1,000. I only have $1,000, and I don't really know what to do with it, but I want to invest it. So basically, the question is, how to invest $1,000. Now, we're in a very interesting time, folks. The Federal Reserve is making changes. They are making big changes, and we continue to see the fallout of the Federal Reserve's changes almost on a daily basis, it seems like. All right. And with that in mind, we have to be very, very cognizant about what we do right now. You see, guys, the Fed is really targeting inflation. Inflation is still very high. It's not as high as it was. And the prices of, goods and services, they haven't really come down yet. But the rate of inflation is slowing down. So the Fed is making progress. But why is the Fed raising interest rates? That's the question that you need to understand first before you make your next decision. Now, the Fed has raised interest rates in an attempt to lower inflation. And in order to do that, they need Americans to stop spending so much money. And so what they've done is they've made it more expensive to borrow money. Now, if anybody's trying to go buy a house, whether it's a primary residence or an investment property over the last, let's just say over the last year compared to a year prior, it's a lot more expensive to do that. Also, if you're trying to buy a car, even if it's a new car, a used car, a Honda, a Rivian, an EV, a Lexus, a BMW, really doesn't matter. If you go and try to get a car loan today, compared to how much it cost you a year ago, 2 years ago, it is so much more expensive today. Why? Because the Fed is trying to get Americans to stop spending so much money. And I learned a long time ago, you never want to fight the Fed. The Fed's got too much muscle. I mean, it's hard to beat the Fed. So if that's the case, if the Fed wants us to stop spending money, right, and we go with the Fed, you go with the flow, right? It's kind of like, I don't surf, but I've seen surfers, they go with the waves, right? So we need to understand, okay, so now might be the best time to save and preserve and prepare for what's coming down the pipeline in the future. And I think it takes a little bit of critical analysis to understand, what's the next smartest move to do next, especially if you only have $1,000 to work with, right? We all know right now, $1,000 doesn't quite go nearly as far as it used to, say 5-10 years ago. $1,000 used to be a big deal. Now it's like you can't walk down the street without spending $1,000 just to get by, right? So you got some options, right? Now, one option is you could buy stocks. Now, of course, you look at the S&P 500 over the last 25, 50 years, you're going to get somewhere between an 8 and 10% return on your money. Now, if you're only investing $1,000 one time, then your return on investment is likely to be better somewhere else. If you only have $1,000, I'm not saying that you shouldn't invest in the stock market. That is not at all what I'm saying. But we always want to look at what are our best options, regardless of how much money we have. In this case, we're talking about how to invest $1,000. But if we were trying to invest $100,000, if we were trying to determine what's the best way to invest $1 million, the conversation would really be the same. What is the best rate of return that we can get for our money, and how much risk are we going to take on? So, the principle doesn't change in terms of how we analyze, what's the best route, right? Now, the next thing we want to consider is opening up a Roth IRA. Now, a Roth IRA is kind of like all right. So you've got any kind of income you receive, you're going to be subject to some sort of taxes, right? So if you can somehow leverage existing loopholes to avoid overpaying taxes, then why not, right? And by opening a Roth IRA to do your stock market investing, you can buy stocks with an IRA, mutual funds, ETFs, index funds, you name it. You're investing after tax dollars, which you would have normally done in a traditional brokerage account. So why not take full advantage of a tax loophole that the IRS put in place for us by opening a Roth IRA? And with the Roth IRA, the money you put in there, your seed capital, your initial investments, this money can grow tax-free. So long as you take it out after a certain age. And I think the age of, I think it's something like 59 and a half. Double check, what the IRS rules are on that one, because these things can change, but they haven't changed in so long. I think it's still 59 and a half, but double check. And, where can you go get an IRA? Where can you go set up an IRA? Well, you can set up an IRA with Vanguard, Charles Schwab, TD Ameritrade. Who else is out there? M1 Finance, Webull. So Fidelity, you can set up an IRA. You can set up a taxable brokerage account with any of your favorite online investment stock brokerages, right? And you can probably set it up in less than 10 minutes. Now, the thing I like, the big thing I like about the Roth IRA is you get to compound your money without getting hit every year by paying taxes on the income you've generated from investments in your IRA. So I'm a huge fan of those. So I tend to want to max those out first. And of course, none of this is investment advice. Always seek your counsel from your own personal investment advisor. I'm not a tax advisor either. Yada, yada, yada. Another thing I like about the Roth IRAs is that you can withdraw your initial investment without any type of tax consequences, because you've already paid taxes on the money you put in. So you only pay taxes on the gains. So that's another cool thing. A lot of people don't realize that. And that's why I tend to want to fund my IRAs first before my traditional brokerage accounts. Now, if you're carrying any kind of debt, credit card debt, high interest car payment, or a high interest car loan, if you have any, store credit cards normally have some of the highest interest on them. So store credit cards usually have the highest interest. Then you got, your Visa, MasterCard, American Express cards. And these cards are, with the exception of American Express, these cards, Visa, MasterCards, they're going to be issued by a bank. Now, the bank might be Citibank, might be Capital One. The bank issuing that credit card could be Bank of America, Chase, JP Morgan Chase, Wells Fargo, a regional bank. But the simple fact of the matter is that 9 times out of 10, probably 99 times out of 100, the interest rate associated with that credit card is going to be variable. And right now, Americans are paying on average above 20% interest on those credit cards. So if you are carrying a balance and getting hit with interest, you might want to start thinking about aggressively paying down that debt, because that is the fastest way to not get rich, by paying interest. We want to earn interest. We want to receive payments. We want to receive income. And if our income is being suffocated and predetermined, or is being predetermined to have to cover debt payments and debt servicing, then it makes it very difficult and next to impossible to build wealth. So paying off debt is an investment. It's an investment in your future, and it's an investment in freeing up your income. Just imagine, I don't know what your bills look like. You probably got rent, food, insurance on your car, insurance on your house, and even if you don't have homeowners insurance, if you're renting, you probably have renter's insurance. You got, car payment, maybe credit card bills, gas, electric bill, gas bill for your home, gas bill for your car. So you got all these different expenses. Just imagine if you eliminated just the expenses that are associated with debt payments and debt servicing. So imagine you could pay off your house, you could pay off your car, you can pay off your credit card debts, you can pay off your cell phone. A lot of people got cell phone payments. And I know this is not commonly discussed, but cell phone payments exist. The cell phone payments are those additional fees that are in your cell phone bill every single month because you didn't pay cash for your phone. You know, these are all debt related payments. So imagine how much money would you have left over if you looked at your budget and you said, hey, I'm just going to eliminate all of these debts. How much free cash would you have left over? You might have a lot of cash left over, and you might say to yourself, wow, I would be doing okay if I paid off all these debts. How much cash would you have left over? And just imagine if you did, how much of that cash could you invest? And if you invested that cash that's been freed up from all these debt payments, how fast could you grow your wealth? How fast could you hit your first $100,000 in invested capital, right? It adds up real fast. And this is why getting out of debt, especially high interest debt, is one of the wisest things you can do. Now, I'm not saying like I don't leverage debt to increase wealth, because there is a way to do that. But I'm just saying, for the average person getting started out, keeping it simple, keeping it basic, paying off debt, paying off high interest debt is one of the best investments you can make. Now, of course, you can also invest in ETFs. You can invest in real estate. And I'm a huge fan of investing in real estate, even with higher property taxes and higher insurance rates, right? So, if you guys saw one of my previous videos, we talked about how much, my mortgage payment had gone up over the last year, and how much my mortgage payment had gone up over the last 2 years. Because even though I have a fixed rate mortgage on all of my properties, it doesn't mean that the mortgage payment will never change. And the factors that would cause a fixed rate mortgage to change, or a fixed rate mortgage payment to change, is you got taxes and insurance. If your taxes change, either up or down, chances are they're going to go up. If your insurance premium changes, could go up or down, chances are it's going to go up. And so even though you have a mortgage payment, it doesn't mean that you never, ever have to worry about your mortgage payment changing. Because that's why, a lot of renters say, hey, I'm just going to own my house. I'm going to buy a house. And that way I don't have to worry about my expenses going up. Technically, no matter what, you're always going to have your expenses going up. Because if you rented, you're at the mercy of the landlord. He or she is likely going to be increasing your rent, right? And it's not necessarily because the landlord's trying to get rich, because most landlords are just mom and pops that are running these properties, that are managing these properties. Like people like me and you. It's not, you'd be surprised. It's usually not big corporations like BlackRock and State Street and, companies like that are owning these properties that are being rented, especially if it's a single family residence. Generally speaking, larger companies, larger corporations will own the luxury apartment complexes, right? The larger companies will own like the apartment complexes that have like 100 units or more. That's generally some big corporation, right? But if you're renting a house, chances are it's just, it's just a regular guy or girl or, husband and wife that have a property that they decided to rent out. So chances are they're not trying to get rich off you. If the rent goes up, it's probably because their expenses went up. I'm not saying that's the only reason why rent could go up, but if I'm renting a property and my property taxes went up and my homeowner's insurance went up by $150, well, guess what? We're gonna raise the rent payment by $150 at least, because there's likely some other expenses that have probably gone up over that period of time of a year. So, if your rent payment went up $150, it doesn't mean that your landlord's making $150 more off of you every single month. Chances are their expenses went up pretty close to what they're raising the rent by. Anyway, but since we're on this topic, a lot of people say, well, Ron, I thought, real estate was a good investment. Why is it a good investment if your property taxes and homeowners insurance can go up? Well, there's a lot of factors that go into real estate investing, right? A lot of tax benefits, a lot of tax breaks. But one of the things you want to do is you look at the numbers before you make a real estate investment. Now, expenses will always be there. So whenever and I'm gonna keep this short because I actually want to go deep dive into this subject into a future video. But whenever you buy real estate, one of the things I always want to make sure is the going rate for rent on a particular property, is the going monthly rent rate equal to or less than the mortgage payment would be if I were to purchase an investment property, an investment, single family home, duplex, a triplex, whatever the case is. Will the average going rate, the market rate for rent, cover the mortgage payment? Because if it doesn't cover that mortgage payment, at a minimum, there's no chance I'm even interested in buying the property. I'm not going to try to bank on future appreciation. I want to know that when I get into this property, it's going to cash flow from day one. And so that way, if property taxes and insurance goes up in the future, well, guess what? It's not going to just be my property that goes up in terms of price. It's not going to be just my property that's having a higher property tax bill at the end of the year. And chances are it's not going to be I'm not going to have the only property where the homeowner's insurance policy goes up at the end of the year. So what this means is that other real estate investors' properties are going to be having these increased expenses as well. So if I have to raise my rates, chances are they're going to have to raise their rates, and the renters are going to have to pay a higher amount. It's not like I'm having a higher expense and so I have to raise my rate and no one else does. And so if I'm the most expensive house on the block, no one's going to rent for me. But if everyone has to raise their prices because of the same problem, well, the rental market will stay good. It'll stay solid and people will keep renting at that price. So that's in a nutshell. Now, aside from paying off debt, becoming debt free, eliminating high interest debt, if you do not have an emergency fund, I would definitely make sure I had an emergency fund of at least $1,000. And that is literally just the start. When I say at least $1,000, it's just it's a small financial target, a little goal for yourself to set, because you want to make sure that you don't have to rely on payday loans, living paycheck to paycheck, and relying on credit cards for emergencies. We don't want to have to do that. So you want to make sure you have at least $1,000 in your emergency fund and work to build that emergency fund up to, for me, minimum of a year. Some people will say, oh, 3 to 6 months emergency fund. Me, I won't even be able to sleep a wink of sleep without at least 1 year of emergency fund covered. So that's what I would do. Now, if you really, really want to step the game up, you could take that $1,000 and obviously you can invest in yourself. Now, this is one of the best rates of return you'll ever get, which is investing in yourself. By investing in yourself, that could be anything from, learning a new skill. If you learn a new skill and that's a high value skill, and let me know if you guys want to learn more about what high value skills are. That way you can figure out what skills you need to pick up so you can start earning more money, because the more income you earn, it's like having a bigger shovel, right? The bigger your shovel, the more work you can get done, right? So whatever you need to do to invest in yourself to obtain greater skills to increase your income, that's going to be a tremendous rate of return right there. Just think about it. Imagine you make 40 grand a year. I don't know how much you make, but just look at how much income you make today. And let's just say you were able to double that income by investing in a course that taught you how to execute a new skill, and that skill is worth twice your current income. So let's just say you work at a construction site, and but you don't know how to work a bobcat or the one of the cranes or whatever, right? So you're making $40,000 a year at this construction site doing something else. Well, let's just say you spent, I don't know, $1,000 on a course. I don't know how much a course costs for this training, but let's say you invest in yourself. You spend $1,000 on a course to learn how to operate a bobcat, and then all of a sudden, or some other construction piece of equipment, and now all of a sudden you can make $80,000 a year. Well, you just turned $1,000 into $40,000 in next to no time. So investing in yourself is probably one of the best investments you'll ever make. But guys, drop me some comments down below. Let me know what you guys are thinking. Let me know if this is making sense to you. I love hearing from you guys. Drop me a like for the video. Also subscribe to the channel. And in the comments, let me know what you guys want me to talk about next. To your right and to your left, I don't know if it's to my right or to your left, you should see some videos up here. Should be floating around here somewhere. Take a look at those videos. Watch those videos. Listen to what we're talking about in these videos. There's a lot to learn. I look forward to bringing you guys more value on future videos, and I'll see you guys on the next one. Y'all be safe.